Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. I have a lot of exposure to bank stocks in my portfolio. Somewhere around 9% of my wealth is invested in a half a dozen different banks. Almost all of them are mid-sized or regional banks. I'm Jason Hall. This is The Smattering. If you're watching this, you're probably hearing about PacWest Bank is the next potential domino to fall in 2023's banking crisis. And you might want to try, and you're probably trying to figure out, are there still opportunities to buy? Is this just too much risk and I need to avoid? Well, I'm going to talk about what I'm doing right now with my portfolio and the banks that I'm interested in to make sure I'm not too exposed to too much of the risk in the banking sector. So let's talk about exactly what's going on right now. We've seen Silicon Valley Signature Bank be taken over by the FDIC back in March. We saw Silvergate Capital elect to wind down its banking operations. The FDIC didn't take it over. Prior to those two FDIC moves, we saw First Republic get taken over by the FDIC very recently after months of going through a process of trying to find some sort of a private market exit. I want to talk about the key thing that's made all of this happen. And it's interesting to me because it turns the thesis of banking a little bit on its head. So what is the basic thesis of banking is that rising interest rates generally should be a good thing for banks. And that's because the economy is healthy when interest rates are being lifted. And the Fed is usually, if anything, that's trying to cool off the economy. But that rising interest rate environment over time allows banks to sell money for even higher price than it costs them to buy the money. So what do I mean by that? They buy the money from you when you deposit it and they pay you a yield. That yield is what they're paying to buy the money. That's basically their cost of goods sold, right? And then you sell that money when you write a loan. In a rising interest rate environment, you should be able to charge more money than you're having to pay to buy the money. Now, depending on the type of loan that you're writing, can create a different level of risk. And what's happened with so many of these banks that so far have struggled is that they wrote really cheap loans for really long periods of time, or they bought mortgage-backed securities that were really cheap loans that were not going to mature for a very long time. What that meant is that they were locked into that cost, right? That low yield, in a lot of cases below 3%, even though their cost of money continues to rise as deposit costs move higher. You can go get a 3.5% yield on a savings account online. Super easy. Take you half an hour to open it up. A couple days, your money transfers over, and you're earning more yield on a savings account than a lot of banks are earning on 30-year mortgages that were written back in 2020. Needless to say, that's upside down for the banking industry. And here's what I'm doing to figure out which banks have the most exposure to that. It's actually really simple to find this information. All you got to do is go find those annual reports that were released earlier this year for the banks. And a lot of them, you get the updates of this in their quarterly filings, their 10Qs, and you find the section where it talks about loans held for sale and loans held to maturity. They're going to give you information about how long before that loan matures, these different buckets, and they're going to break down how much yield they're earning on that as well. You can take that information, those loans held to maturity particularly, and you can compare that to their total loan book and figure out how big a portion of their loans are they earning these super low yields on, and then look at their deposit base and figure out, okay, is this a situation where this bank is going to get flipped upside down and its profitability is going to get really hurt because it's got a bunch of loans that aren't going to mature for more than 10 years that it's earning 2.9% on in this environment? Figure out where that margin of safety is between its liabilities and deposits that it owes back to depositors and the assets that it owns that are not generating enough yield to be profitable in this sort of environment. So that's what I'm doing with the banks that I own, making sure I don't have massive exposure to that, and also looking for opportunity for banks to buy in this environment. Because here's the reality. We're probably going to see some more banks fail over the next year. It just tends to happen. We go through these periods of time about once a decade where things kind of come unraveled, and these sharp rise in interest rates have really undermined the economics for a lot more banks than I think maybe people realize. I'm not calling for a major banking crisis like we saw back in 2007, 2008, and 2009. But what I am saying is that this sharp, jarring change in interest rates is probably affecting more banks, and investors need to be really picky about where they're deploying their capital and thinking about taking on that risk. So what do you do next? I'm going to continue to be looking for opportunities to deploy capital. I'm going to look back through all of the banks that I own, make sure that I'm minimizing my exposure to the ones that are the riskiest, and thinking about finding the opportunities for discounted banks that are in great situations with good upside that I can take on that risk to try to profit from it.